Hi, this is Ben Reynolds with Sure Dividend, and today we're going to be talking about the case for international stocks. And we're going to break this discussion down into 4 sections. Section 1 is on the benefits of a global investing strategy. So this is the why of investing in international stocks. Section 2 is on how to invest in international stocks. So this is going to go over how to actually buy international stocks, the best way to do that, what to look for there. And then section 3 is on the tax implications of international investing, because there are different taxation rules with investing in international stocks in many cases. It's important to know that before investing in them. And finally, section 4, we have an exclusive opportunity for webinar participants that I'm excited to tell you all about. So with that said, let's begin. Section 1, why buy global stocks? Most US investors buy exclusively US stocks. And this made more sense decades ago than it does today. The global investing landscape has changed significantly. The US might not be the best place to find investment ideas today. In fact, I'd argue that it probably isn't, for several reasons which we'll go through shortly. Buying international stocks is more attractive now than maybe ever before, at least in a very long time. A lot of that has to do with valuation and valuation of the US stock market relative to most international stock markets today. In addition to valuation, economic growth, the US is growing slower than most countries today. It's growing below the global average. So that means there's, all things being equal, companies have, it's easier to grow a business in an economy that's growing at 7% a year than it is to grow a business in an economy that's growing at 2% a year. And then finally, their active management tends to work better in global markets because they might not be quite as efficient as US markets. So we're going to discuss each of these in detail in the coming slides. Why buy global stocks? Reason 1, domestic stocks are historically expensive right now. It's a kind of a scary time to be investing in US stocks. The image below shows the historical trend of the S&P 500 Shiller's P to E ratio. And the Shiller P to E, it's also called the PE10, measures the average earnings. It's the current price of the S&P 500 divided by average earnings over the last decade. And so this sort of smooths out fluctuations from earnings in one year. For instance, in 2009, in the Great Recession, earnings were super low. That doesn't mean, that would artificially show a high price earnings ratio. With the Shiller P to E, you don't have that flaw. So it's a better long-term valuation metric. And the image below shows that the US is in historically severely overvalued territory. The only time the US market has been more expensive than today is at the height of the tech bubble in around 2000. We're at a higher point than 1929, just before the Great Depression. So I'm not saying there's going to be another Great Depression coming, but certainly now is not the best time to find value in the US market. And interestingly, the same doesn't hold true all the way for international markets. International markets, they're not extremely historically cheap, but they are historically cheap relative to the US market. And the image below shows that international stocks are a much better deal today versus the US stock market. So that's something to keep in mind when you're looking for individual investments. It's easier to find undervalued securities in markets that have lower valuation multiples overall. And people in the United States, we often think of the US as a quickly growing economy or the strongest economy in the world. And while it is, it's the largest economy in the world, it's no longer the world's leader in economic growth. The leading countries for GDP growth are below. You'll see India is actually leading right now with 7% growth. Then China at 6.6%, Indonesia 5.2%, Turkey just below 5%, and then Iceland and Slovenia, which those two surprised me a bit, just above 4%. And then you compare that with the US. The US is expected to grow at 2.5% a year. So, that's almost 3 times slower than India. It's significantly slower than some of the faster growing countries in the world. And the world on average is expected to grow GDP at 3.7%. So the US is expected to grow slower than the world. And It's an interesting fact to keep in mind when you're looking at what markets to invest in. And all things being equal, this means the average international stock should perform better than the average United States stock because it has a better backdrop for growth. And that does, all things aren't equal. A lot of United States corporations have international presences, but this would definitely stand true for a strictly United States-based company. There's strong economic growth driving earnings growth. And you can see that the U.S. corporations had been growing their earnings quicker than international corporations. And that trend appears to be reversing now. So we're seeing the opposite happen. So now appears to be a good time to look to international markets for valuation, for the reversal of this trend here, and for overall economic growth. And this is quite interesting. Active management appears to be more powerful in international markets than U.S. markets. And the way I like to think about this is, in the U.S., there's a lot of really smart people chasing after relatively few undervalued securities. In international markets, they might be smaller markets, they might be less efficient, and there's not as much money chasing so few bargains. So you kind of have a better chance of picking stocks individually in international markets relative to U.S. markets. It's easier to outperform international markets with active management than it is to outperform in U.S. markets. So again, something to consider when looking for individual stocks. Finally, with investing, if you're looking for undervalued securities, if you're looking for high quality dividend growth stocks, the person who turns over the most stones is going to find the most investments that are favorable. And you can see from the images below, the U.S. only has about 25% of the world's stocks of corporations. So you're missing out on 3/4 of your opportunities by limiting your view to just the U.S. And we've already seen that the valuations are lower in international markets, and there's so many more stocks there. It's 3 times more stocks just in general. So there's likely to be a great many more high quality undervalued businesses internationally than domestically. And then international stocks are appealing for diversification purposes. So you'll see in the image below that there are diversification gains to investing in international stocks versus investing just in U.S. stocks. And that's another thing to consider when seeking to move beyond just U.S. stocks in your portfolio. Section 2, how to invest in international stocks. So the previous section we discussed the why. This is the how. There are 2 primary ways to invest in international securities. One is through American Depository Receipts, or ADRs, and 2 is to invest directly from a foreign stock exchange. And just for ease, ADRs are generally preferable, and we're going to discuss the differences between these 2 in upcoming slides. American Depository Receipt, or ADR, is a certificate issued by a U.S. bank that represents a specific number of shares of a foreign company. So it's basically an easy way to invest in international stocks without opening an international brokerage or something of that nature. A few examples are below: British American Tobacco, and the ticker symbols are next to them. So if you have a brokerage in the U.S., you can just type these tickers in and purchase these stocks. There's no further research required. I mean, obviously you want to research the stocks, but there's no further action necessary to buy them. Taiwan Semiconductor. And these ADRs, they tend to be larger corporations. These are not going to be micro caps in general that have ADRs. And they tend to be more established. There are 3 types of ADRs. The 3 levels are below, and they go in order. So level 1 is the least secure, and level 3 is the most secure. Level 1 ADRs are exempt from SEC reporting, and they usually trade over the counter. So this means they're not trading on a major stock exchange, and they don't have to report anything to the SEC. So all things being equal, we prefer our recommendations to have some oversight over them, to be responsible to the SEC to report accurate financial reports. And level 1 ADRs don't have this obligation. So there's less certainty surrounding their financials. And the liquidity could be much worse. So in an OTC market, there could be 0 shares traded a day. There could be 10 shares traded a day, and there's not enough volume for you to actively buy and sell these securities, which can be very scary, especially if you're looking to move out of a security. Level 2 ADRs have to report to the SEC, and they can be listed on major stock exchanges. This is much safer. This is a huge leap up from level 1. Level 2, we tend to regard from a transaction perspective as relatively safe. Level 3, the same as level 2, with the additional benefit of the companies that are level 3 ADRs can use public offerings to raise capital from United States investors. So they can actually issue shares to United States investors and raise capital in US markets. There's really not a big functional difference between level 2 and level 3. Both are as safe as investing in a normal US stock, or nearly as safe. Level 1 is the exception there. They can be risky. They don't have the same reporting standards as other companies, and they can be illiquid with low trading volumes. So I guess the key takeaway here is level 2 and level 3 ADRs are similar to investing in normal stocks, whereas level 1 is likely much riskier. The alternative to ADRs is to invest directly in the security via its home exchange. And there's 2 ways to do this. You can open a brokerage account in the country the security you want to buy. So you could open a brokerage account in China if you want to buy Chinese securities. You could open a brokerage account in Brazil if you want to buy Brazilian securities, and so on. That would get pretty unwieldy quickly. You wouldn't want 10 brokerage accounts in 10 countries and have to transfer money between all of them. So the alternative is to enable a global account with your current brokerage. And most large brokerages have global trading accounts. Interactive Brokers, Fidelity, E-Trade, and Charles Schwab do. Interactive Brokers is especially good for international investing. But certainly between these 2 choices, enabling a global account with your brokerage is the preferable choice. And then ADRs are probably more preferable than either of these 2. We recommend buying ADRs if an international stock is available as a level 2 or level 3 ADR. So again, these are the lower risk ways to invest. If not, a relatively liquid level 1 ADR is available. It can still be a good option, but you really want to check the liquidity there. How many shares are traded every day? What does the volume look like? And if you're like, okay, if you look at the amount of money you have to invest, and if it's substantially above or anywhere near the average daily volume, you're not going to be able to buy and sell in any reasonable way without really moving the market price, and it probably won't end well. You probably won't be able to get out of your positions. So if a level 2 or 3 is not available and there's not a level 1 available with good liquidity, then you'll need a global trading account. And there are tax implications to international investing. So we've been over the pros of international investing. There are some tax consequences. We feel that in general, the pros far outweigh the tax consequences. That there's 2 ways investments are taxed. There's capital gains taxes, and these are taxes on international securities when you sell if you're up. And they're generally the same as on domestic securities. So we're not going to cover capital gains tax in much detail here. Dividend withholding taxes, however, are different. So most countries will withhold a portion of every dividend payment as a withholding tax. Every country's withholding tax is different based on the government's tax policy. So Canada has a different dividend withholding policy than the United Kingdom. The United Kingdom actually has a 0% dividend withholding tax in most cases. So that's a very favorable one. Canada is not as favorable, but in some cases they have a 0% rate if you are investing from a retirement account and you follow the necessary paperwork. It's important, if you're not comfortable with this, if you're not secure with the knowledge of it, you should consult a tax professional for more information on your particular tax situation, because taxes they're nuanced. It depends on your situation, and there's not a one size fits all. We can't just say like, here's a slide with international dividend withholding taxes and that's that. There are changes to be made there. And that covers the basics of what I wanted to go over today with you about international investing. With that said, we have an exclusive offer for webinar participants I'm excited to tell you all about. And as a thank you for participating, we wanted to offer you a discount on our international newsletter. The Sure Dividend International newsletter is normally $79 a year. And if you look at that price, we already priced it very low because we want as many people as possible to benefit, one, from high quality dividend growth stocks, and then two, from an expanded international universe of high quality dividend growth stocks. So we figured at $79 a year, that's a very reasonable price point. And you can look at other international newsletters and see they're usually multiples of this price. And as a famous investor says, price is what you pay, value is what you get. So we try to pack as much value as we can into this newsletter. For webinar participants today, we're offering the newsletter for just $58 a year. The price won't change. It's not a $58 a year and then, oh, it's $200 next year. It's $58 a year, year after year. Savings of $21 a year forever. And the same offer is also available on our two other newsletters, Sure Dividend and Sure Retirement. And Sure Dividend focuses on high quality dividend growth stocks, primarily in the United States. And Sure Retirement focuses on high yielding stocks, REITs, MLPs, and BDCs. These are 4% plus at a minimum, some over 10% yields. And again, these are also for $58 a year each, with the exclusive webinar codes that we have. Thank you for attending. I appreciate everyone who came to listen to this. You can capture the discount directly within this webinar, which we'll be putting up on screen shortly. And we're also going to send a discount link to your email after the webinar finishes. So with that said, I'm going to, okay, we're moving over to the co-browser right here, and there's a sign-up form. And while this is up, I wanted to ask, does anyone have any questions? Because I'd love to answer some questions about international investing. That's researching international stocks. It's compelling to see the valuation differences. That's what's really stuck out to me the most, is how many more securities there are with price earnings ratios well under 15, under 10 in many cases, strong businesses, high dividend yields, likely to grow quickly, and then they're, because of these factors, likely to have higher total returns. So that's something that I found looking at international stocks relative to US stocks. There are still a few bargains to be had in US markets, but they're typically companies that are going through some sort of temporary trouble. So you might hear that Amazon's entering healthcare distribution, and so some healthcare distributors might have their share prices decline. And that would be an example of a time when a temporary event has caused a panic in a stock price, and there might be a bargain there. But in the US, it's very difficult to find those. It's not as difficult in international markets right now, and we're seeing better bargains in general. So that's one thing I wanted to stress, just my personal experience with looking at international stocks. And if there are no questions, I just want to thank everyone for coming and appreciate it. And let me know if you have any questions via email as well.